Hello, and welcome to Mukoya Finance. My name is Saruddin, and I'll be your finance tutor in this class. In this tutorial, I'll explain to you what an income statement is, the presentation format of an income statement, as well as the key elements of an income statement. To start off, it is important to understand how income is recognized on a company's balance sheet. When a company makes profit after settling periodic loan repayments to its lenders, the remaining profit will be added to equity on the balance sheet. When we increase equity, we have to either decrease liabilities or increase assets in order for the balance sheet to remain balanced. Therefore, the main link between the balance sheet and the income statement is that profits generated in the income statement gets added to shareholders' equity in the balance sheet as retained earnings. If sales was on credit, an asset such as account receivable is created. Later, when cash changes hands, the company's financial records simply reflect that cash has been received to settle an account receivable. Therefore, income recognition can occur independently of cash movement. Similarly, if a company receives cash in advance and is expected to deliver products or services later, this increases cash, which is an asset on the balance sheet. To keep the balance sheet balanced, the company will record a liability for unearned revenue. And revenue will be recognized as being earned in the income statement over a time period as products and services get delivered. An example is a subscription payment for a newspaper that will be delivered periodically over time. Throughout this tutorial, we'll work with a hypothetical company that was set up using $50,000 of equity and $50,000 of borrowed funds, resulting in $100,000 of assets. The company uses the $100,000 to buy land and 2 buildings for $40,000. It also purchases machinery worth $30,000 and raw materials worth $10,000. Left with $20,000 in cash, the company considers it inefficient because it would not need that amount of cash for its operations over the accounting period. So it decides to invest $15,000 in another company. And now the company is left with just $5,000 in cash. During the accounting period, the company uses up $7,000 worth of raw materials to produce 500 pairs of shoes. The company also incurred production and sales costs, including staff salaries, bringing the cost of production to $10,000 during the accounting period. In the same accounting period, the company sells all the 500 pairs of shoes for $80 each and receives $40,000 cash from the sales. Now, let's see how income statements work. Income statement, also known as profit and loss statement or statement of operations, presents information on the financial performance of a company's business activities over a period of time by communicating how much income and other revenue the company generated during the period and expenses the company incurred to generate that revenue and other income. The key elements of income statement are revenue, expenses, gains, and losses. Revenue is the amount charged for the delivery of goods and services in the ordinary activities of a business, also referred to as sales or turnover. Revenue is reported after adjustments to remove things like cash or volume discount or other reductions. In our hypothetical company example, our revenue is $40,000, which is the amount received for the sales of 500 pairs of shoes. A company's total revenue may comprise operating and non-operating revenues. Operating revenue is realized through the company's core business activities, while non-operating is realized through non-core business activities. For a manufacturing company, the revenue from core business activities refers to revenue from the sales of products, while for a service company, it refers to revenue generated from offering services. In our hypothetical example, a total of $40,000 is operational revenue as it is realized through the sales of the company's products. If, however, the company realized $5,000 returns from its $15,000 investments during the period, the $5,000 is non-operational revenue and it will be added to the $40,000 operational revenue to have $45,000 total revenue. Revenue recognition refers to the reporting of revenue on the income statement. Revenue should only be recognized when it is highly probable that it will not be subsequently reversed. Consequently, when the estimate of total revenue is not reliable, that is, it could potentially be reversed, for example through customer returns, it may result in the recording of a small amount of revenue upon sales. In a simple scenario, revenue recognition is straightforward. A company sells products or services to a buyer for cash and does not allow returns. So the company recognizes revenue when they exchange goods or services for cash and records the amount of cash received. However, determining when revenue should be recognized and at what amount is sometimes more complex for reasons such as excise taxes, customer returns, customer rebates, trade discounts, or other promotions. For example, cash received could include excise taxes, which are usually imposed on some goods and services and paid directly by the business. These taxes are often passed on to the consumers who may not be aware that they are paying the taxes because it is included in the price. These taxes have to be backed out before recognizing the remaining revenue on the income statement. Gains represent inflow of economic benefit from other activities, like sale of long-term asset or the sale of a subsidiary. Gains, which are also called other income, are similar to revenue, except that they arise from activities that are not part of a company's primary business activities. In our hypothetical company, if we sell one of the buildings for more than the carrying value, the difference is referred to as gain rather than revenue. Expenses are decreases in economic benefit during the accounting period in the form of outflows or depletion of assets, or incurrences of liabilities that decreases equity other than those relating to equity distribution to shareholders. Expenses are typically categorized into 6 groups: the cost of goods sold, sales, general and administrative costs, depreciation and amortization, other operating expenses, interest expense, and income taxes. Expenses are deducted against revenue to arrive at a company's net profit or loss. Just as in the case of assets, expenses may also be aggregated either by their nature or function. An example of grouping together expenses by their nature is aggregating depreciation on machinery and depreciation on the company's delivery van into a single line item called depreciation. On the other hand, an example of grouping by function is grouping together cost of labor or material, depreciation, salaries of salespeople, and other expenses directly related to the sales as cost of goods sold. In our hypothetical example, the sales, general, and administrative cost of $10,000 could be added to the $7,000 cost of raw materials to have one line item called cost of goods sold. The definition of expenses encompasses losses as well as expenses that arises in the cost of ordinary activities of a company. These include expenses like cost of sales, wages and depreciation, and usually take the form of an outflow or depletion of assets such as cash and cash equivalents, inventory, as well as property, plant, and equipment. Non-operating expenses are expenses that are incurred by activities that are unrelated to the business's core operations. Examples of non-operating expenses are interest charges on borrowed funds as well as losses on the disposal of assets. In our hypothetical company example, the cost of goods sold of $17,000 is an example of operating expenses. On the other hand, the interest charge on $50,000 of borrowed funds for that accounting period is regarded as non-operational expense. In a simple scenario, expense recognition is straightforward. For example, a company purchases inventory and sells all of the inventory within the same accounting period. Here, the cost of the entire inventory is recorded in the income statement. However, in most cases, some of the current period's sales are made from inventory purchased in the previous period. Therefore, a matching concept is used, which requires that a company recognizes some expenses, such as cost of goods sold, in the same period as revenue from the sales of the goods, thereby matching revenue and the associated expenses. In our hypothetical company, an example is when all the $10,000 of raw materials was used to manufacture shoes and all the shoes were sold within the same accounting period. Here, the whole $10,000 is recognized, and we will have $20,000 in cost of goods sold. However, because only $7,000 worth of raw materials was used, only $7,000 will be recognized as part of cost of goods sold because that is the amount that was used up in the current period. The remaining $3,000 will be recognized in the period they are used up or sold. Losses represent other items that meet the definition of expenses and may or may not arise in the course of the ordinary activities of the company. Losses represent decreases in economic benefits, and as such, they are no different in nature from other expenses. A typical example of losses are those resulting from disasters such as floods, as well as those arising from the disposal of non-current assets. Even though losses typically arise from secondary business activities, In some cases, they may also be considered part of operating activities. For example, a loss due to a decline in value of inventory may be considered part of operating activities. In our hypothetical example, an example is the sale of one of the company's buildings for a price less than the carrying value of the building. The difference here is recognized as a loss. Net income, also referred to as net profit or net earnings, is defined as revenue minus expenses plus other income minus other expenses plus gains minus losses. Net income is often referred to as bottom line because of its proximity to the bottom of the income statement. Where the result of the equation is negative, it is referred to as a net loss. To understand this better, let's see an example. If a manufacturing company sells its products, the cash received is recognized as revenue, and the costs incurred to generate these revenues are expenses and are presented separately. If the company also has investments in other companies that earn some income, that income is recognized as other income, while the interest that the company pays on its loans is recognized as other expenses. Additionally, if a manufacturing company sells surplus land that is not needed, the transaction is reported as gain or loss. The amount of gain or loss is the difference between the carrying value of the land and the price at which the land was sold. Income statement can be presented either as a separate statement followed by a statement of comprehensive income that begins with the profit or loss from the income statement, or as a section of a single statement of comprehensive income. Income statement formats may vary depending on the local regulatory requirements, the diversified scope of the business, and the associated operating activities. Income statements are reported on a consolidated basis. This means that they include income and expenses of subsidiary companies under the control of a parent company. When one company, known as the parent, controls another company, which is the subsidiary, by owning more than 50% of its voting shares, the parent presents its own financial statement information consolidated with that of the subsidiary. This means that each line of the consolidated income statement includes the entire amount of the relevant line item on the subsidiary's income statement after removing any transactions between the parent and the subsidiary. The net income attributable to minority interests is also shown at the bottom of the income statement next to shareholders' equity. Some uses of income statement are: the income and expense component can help an investor learn what makes a company profitable or not. The income statement also allows for comparison with industry peers on various measures. It also enables research analysts to compare the company's performance year on year or quarter on quarter. Additionally, income statement discloses information regarding a company's operations, the efficiency of its management, and the possible segments that may be eroding profits. The income statement is also used to determine companies' abilities to make promised payments on their debts over the course of the business cycle. It also provides essential inputs into companies' valuation models, which includes estimates of earnings. The income statement also allows us to separate prior year's items of income and expense that are likely to continue in the future from those that are less likely to continue. It is therefore no wonder that corporate financial announcements frequently overemphasize information reported on the income statement, particularly earnings, more than the information reported in the other financial statements. And this brings us to the end of this video segment. In the next video, I will explain some of the most common subtotals that you see on an income statement while guiding you on how to build an income statement. If I have in any way made you understand income statements better, please hit the subscribe button and follow my channel in your quest towards becoming a finance expert. See you in the next video.